Hi, my name's Edward Martin. I'm the CEO of QuotedData. Today we also have Head of Investment Companies, James Carthew, who will be doing a deep dive into dividend hunting in the infrastructure and renewable sectors. Before we dive into that, I just wanted to explain a little bit about QuotedData and what we do. We are a research and news and data provider. We also provide information on events, and it's geared towards private investors. So thank you for coming today. Our goal today is to sign up new readers. So if you have a chance, do go onto the website, QuotedData.com, and if you like what we say and the content on there, please do sign up if you want more emails to your inbox, but it would be great to be able to send that to you. That would be great. It's sponsored by the industry, so we are able to give it away for free. So, and thank you for the plug earlier. Anyway, on to more, I guess, interesting things. James and I had a chat at the beginning of this, just wondering, we thought we all fancy a little bit more income, and it has been an interesting couple of years with COVID and war around the world, and inflation has the era of free money has disappeared, and inflation's here, interest rates have risen, and that has meant an increase in the cost of debt and has impacted discount rates. And one of the sectors that's been hit hard has been the infrastructure and renewable energy space, and but there is still huge demand for these sort of things, and they are in the main, and some of them are index linked. So we just think it's a very interesting time to lift the bonnet on that. And we also thought, how best to invest in this space? And we do love our investment companies, but they are a better structure than the open-ended fund to invest in these illiquid assets. So, and the investment companies industry has been sold off, and they're trading at quite big discounts to NAV. So, who better than James Carthew to lift the bonnet on the sector? Discounts do tend to mean revert. We think you can get growth from the underlying assets and certainly income generation, and also the mean reversion on the investment trusts and the lovely yield you get from this discounts, buying in at these sort of levels. So we love that sector, but we obviously don't give advice. Please do go onto the website, sign up, and the information is all there for you to do your own research. But James, can you take it away?
Renewables and infrastructure, the two sectors we pulled out. I mean, they're not the only things that have derated, but they have been quite hard. And for me, the attraction is not so much the capital appreciation that you might get if they come back into favour, but the yields that you can get now if you invest in them. This is what all our data comes from Morningstar, so we just sort of reproduce it. And we'll go on and explain there's a mistake on there, but never mind, we'll fix that as we go through. But there are some quite chunky yields available, as you can see there. And on the renewables side, they're even bigger. So I think there was something like 17 funds on a yield of more than 7% at the moment. And those yields are pretty solid, but as we'll come on, not all of them are, but most of them are. And I think that's what makes them attractive. And these are decent-sized funds for the most part, and they're trading on quite big discounts to the underlying asset value, as Ed's kind of already alluded to. Some of those are really quite chunky, and it does mean that if we do get this return to favour, this sort of improvement in the sentiment, you could get quite big capital appreciation. As I say, that's not the main point of what I'm talking about. So what's gone wrong? This is just illustrating what the discounts have done over the past few years. If you don't have to go back very long before, every single fund in these sectors was trading at a premium to asset value. COVID obviously knocked everything, but the derating started to kick in when interest rates started to go up, or when people thought interest rates might start to go up, and now it's become really quite serious. Partly we had this backdrop of massive fluctuation in power prices, which is for the most part, been quite good news for most of these funds because obviously they're generating power, if they're renewable funds, from wind and solar and hydro in some cases. So their cost inputs weren't going up, but the prices they were getting for their power were zooming upwards. And so they did make bumper profits for a while. And the reversal of that is one reason that people have cited why these things have sold off a bit. Some of that windfall was taken away by the government. There was an electricity generator levy brought in that captured some of that. But it's still, the numbers aren't too bad. And power prices remain quite volatile. Although we've come all the way back down again, we haven't actually come back to the levels that we were trading at before 2019. So you're still getting sort of quite decent numbers in terms of the power price that they're earning. All of this power price is fed through into inflation. It's one of the main reasons why we've had the big inflation. But as we all know, inflation is coming down. And the question is really now how much further it's going to drop and how quickly that's going to happen. And then on the back of that, what will happen to interest rates? Now, I haven't put a chart of interest rates up here because we all know what they are, but I thought it was more interesting to look at the yield on the UK government 10-year bond. That was next to nothing for a very long time. This whole sort of easy money environment that we had in the wake of the financial crisis. And then when COVID hit, the interest rates were slashed again. And then when inflation started to pick up, it became obvious that people would have to put up, the banks would have to put up interest rates to choke that off. It didn't happen straight away, but the bond yields started to move first. And as bond yields were going up, then the relative attraction of the yields on these funds was going down. So you could take a fund that was yielding 4%, and it got to a point where actually I can put that on deposit and I can get 4% in the bank, and there's a lot less risk involved. So that was one reason why people sold out. Then we get to like October last year, and there was a definite wobble in the market where people were panicking a bit, and the yields went above 5% very briefly. But then people said, actually, inflation now seems to be under control, and it does look like rates are coming down. And that was very good news for a while. And then we get through to January, and the UK December inflation number was higher than we expected, and that was another negative again. And then there was a dodgy US inflation number, and that was another leg down. And actually what we've had, even though the bond yields have come off a bit, actually many of the discounts on these funds are actually wider than they were even before this happened. So I think we are at a turning point, and I think this is a good opportunity to get in now. It definitely feels to me like they're oversold, and the general trend is going to be, at least that's the bottom, and then sort of positive from here. So I said, no, there was a mistake in here. If you know anything about the Digital 9, you'll know that that was an accident. This was an infrastructure fund that was investing in digital infrastructure. The managers got carried away, thinking that they could just keep raising more and more and more money. They bought lots of things that were quite cash consumptive, and they just needed more and more cash to fund them. And the money ran out, and they maxed out their debt. And then shareholders went, this is crazy. They had to suspend their dividend, and then they started selling off bits of the business, and it's now in wind-up mode. So that dividend yield doesn't exist anymore, no more dividends. But the fund underneath that, GCP, I think is an interesting one. It's one of our clients, so it's one of the ones that we've got quite a deep dive on how it works and what's in the portfolio and the sort of ethos behind it. That's all there in the notes. And that yield of 9.4 is really quite chunky. It's the idea of the fund, when it was launched, instead of investing in the equity portion of infrastructure, it would lend debt to it. And that should be safer, in theory, than investing in equity stuff, because if anything goes wrong, the debt investors get paid out first. So you think that, from a yield point of view, it would be trading below the others, but it's not the way it's worked out. Gravis, who run this, they've had a fund of funds, an open-ended fund of funds, investing in these things for a while. That's been really decimated, and partly because there's been this problem with cost disclosures that have made that fund look very expensive, which we are trying to get sorted out. There's lots of debates in the House of Lords about trying to get the cost things sorted out. And it may happen, I hope it will happen. But institutional investors have been selling these things. GCP has been one of the hardest hit, but they've been selling everything, not these funds and the renewable funds as well. And retail investors, although you're a big, important part of the market, you're much less of a percentage of the shareholder registers of these funds than you are in the older equity funds. So one of the hopes would be, if we can turn you on to the idea that these things are actually interesting, that more retail investors will buy them, and that will help sort the problem out. We'll wait and see. A little bit more about GCP. The first few bullet points there, that's what it's trying to do. So the main thing, the manager, if you talk to him, is really cautious about what he's investing in. He's really kind of risk averse. And our whole point about the cash flows are going to be predictable and there isn't too much threat to the capital. And they've done pretty well with that. It's not a fund that grows its dividend over time. It pays out quite a high level and that's sort of like fixed for a while because it's a debt type investment. But quite well dispersed across different sorts of types of infrastructure. So some renewable type infrastructure, but other things too, like they've got some exposure to the supported living sector there, some exposure to the old public-private partnership and PFI type investments that the government got back, which are really safe. And they're the sort of things that are in HICL and the other things as well. So I do think this is a really reasonably safe yield. The dividend was covered last year, 1.13 times, which is always a good thing to look out for, how good the dividend cover is on these things. But the crucial thing here is the board are really conscious that this thing is too cheap and something needs to happen. So they are saying, look, we don't want to wind up. They explore different ways it can be merged and make it bigger and change what happens to it. But what they've come back down to is they're going to sell off part of the portfolio, some of it naturally, because these things are mature anyway. Some of it they're actually going to find buyers for, free up about 150 million quid, and give back at least 50 million of that to investors. So some of the other money was going to be used to reduce their floating rate borrowing. But that will change the supply-demand dynamics in the shares and hopefully will drive that discount down and the yield down and your share price up. So you buy in this thing on a 9.4 dividend yield and hopefully you'll get some capital appreciation as well as collecting the dividends. Renewable energy stuff. So I put up this before. Some of these things didn't really work and they're given up. So there's a couple of energy efficiency things that were just never big enough. And although they got their money deployed, there was just no real support for them, so they're going. There's a US renewables fund that just got hit by lots of different accidents, basically. It had a big wind farm in Texas, and a tornado took out the connection to a grid, and they couldn't sell the power. And so that's been a disaster, and they're giving up as a ghost as well. And then the one that's been in the news recently is this Asian Energy Impact Trust, which was used to be Thomas Lloyd. They got hooked into building a solar farm in India that it turned out the economics just don't work and then they couldn't get out of it. There was a penalty. And so there's a headline in the story yesterday because it was one that the government, UK government put money into because it was all sort of promoting renewables around the world. And at the moment they're sitting on 80% loss of their money. Not great. So those are the bad things. Ignore those. Within this group, there are 3 battery funds. Top of the list there, Gore Street Energy is one of those. They're a bit more complicated, and I think you have to really get your head around these, whether you really want to back them or not. There's been a problem that really hit Gresham House and is sort of going to affect Harmony once it gets going, in that they're not being able to use their battery storage with the national grid. The national grid's software systems don't work, and it's the whole thing, and that won't get sorted out to the end of the year. So they've had to suspend their dividends, and it's all a bit worrying. The safest one of the 3 is the cheapest, Gore Street Energy Storage. But as I say, it's a complicated story. It's attractive because they've got investments in Texas and Germany and California rather than the UK. You want to avoid the UK when it comes to battery storage at the moment. Anyway, next one down. though. You may have seen them, they presented this morning already. They've got a stand down here already. Next Energy Solar, that's now inexplicably trading at an 11% dividend yield. And I honestly, if you'd ask me why, I just have not got a clue why. It just doesn't make any sense to me at all. We think that's a bargain. I've got a bit more stuff on this. So it's a really simple fund. It's just doing solar energy. It's mainly in the UK. It's got little bits in other parts of the world as well. And it's quite a big portfolio. It's been going 10 years now, or 10 years next month. So 933 megawatts across 100 different solar assets. Really long life assets, these things. Very predictable revenue because a big chunk of that revenue is government subsidies that are locked in for 10 years or so. And then the power price the powers that they've generated, they sell it forward. So they pre-sell a lot of the power that they're going to generate next year. I think 75% of the power they generate next year is already sold at 84 pounds a megawatt. And if we went back to that chart, that's higher than the current power price. So really predictable income, really solid income, and yet trading on a big discount. And I don't really understand why. They are also conscious that they've got to do something about this. So they were building new solar plants. Under sort of Cameron, he stopped subsidising new solar because the price of installing this stuff has come down so far now, it didn't really need it. But the new solar plants, they can sell power through a government-backed auction mechanism, and that secures your revenue for years to come, and it's all index-linked, and that's great. So they've got some of those assets, and they're going to sell them off. There were 5 of them they said they would sell. One of them got sold last November. There's 4 more that they're going to go fairly soon. They've just put some results out. They said, we've got the deals lined up. It's two sets of 2 deals. So that will free up cash. Again, they can buy back shares, which will help get the share price up. They're also going to reduce the risk involved because they've got floating rate debt in there, so they're going to get rid of that. Again, I just feel like this is at a turning point. It's not obvious to me why it's selling off, and so therefore I think it's an opportunity. That is a chart of its dividends since it started, and those numbers at the top, that's how much the dividend was covered by cash flows every year. So every year it's covered by cash flows. This is a really safe dividend. And the forecast there, 1.3 times for this year. So 11%, what's not to like, really? Fair enough, which is the last slide. So the point is, we are quite big into these 2 sectors. We've got detailed notes on our clients. We brought a whole load with us. I think they've almost all gone. But nevertheless, if you can't go down to the slides and stand and get hold of them, you can get them off our website. You can sign up as Ed has said, and come and chat to us if you want to ask questions. I do think this is an interesting part of the world, and maybe one that has sold off so far that now the only way is up.